Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. Myth 2. You can't beat the market. Okay, it's true that 96% of all mutual fund managers have not been able to beat the market in the last 20 years. But you're not a fund manager and you're not judged by whether you beat the market. Your financial skill is judged by whether you're living comfortably when you're 75. You shouldn't care whether you beat the market. If the market goes down 50% but your fund manager loses only 40% of your money, he may have beaten the market, but does that seem good to you? Rule number 1: investors expect a minimum annual compounded rate of return of 15% a year or more. If we can get that, we don't care what the market did. We're going to retire rich anyway. Judged by that standard, rule number 1: investors. Well, rule. The myth that you can't beat the market was started in the 1970s by, among others, Professor Burton Malkiel of Princeton University, who did lots of research purporting to prove that nobody beats the market. We'll be going into greater detail regarding Malkiel's theories later on in this book, but we must mention him here to debunk this myth. His book, A Random Walk Down Wall Street, still sells. He influenced a generation of professors in business schools who, as a body, subscribe to what has become known as efficient market theory, EMT. EMT says markets in general, and the stock market in particular, are efficient, that is, they price things according to their value. In the stock market, the ups and downs of the market are caused by rational investors responding minute by minute to the events that may affect their investments. According to EMT, the market is so efficient that everything that can be known about a company is already, minute by minute, figured into the price of its stock. In other words, the price of the stock at all times equals the value of the company. If that's true, say the professors who believe in EMT, then it's simply not possible to find a stock that's undervalued, and it's equally impossible to pay too much for a stock. Why? Because price is always equal to value. So there are no deals in the market, and there are no rip-offs. This situation, EMT theorists say, accounts for the fact that almost no fund managers ever beat the market. These fund managers are smart guys, and if none of them beats the market for long periods, then the market must be perfectly pricing everything. But some people do beat the market for long periods, and the point of this book is to show you how. You'll soon realize how false EMT really is. In 1984, Warren Buffett gave a lecture at Columbia Business School in which he showed that at least 20 investors, who he predicted would have high rates of return, all beat the target of 15% handsomely for periods longer than 20 years. All of these investors hailed from the same school of investing, which he called Graham and Doddsville, because all had either learned from Professors Graham and Dodd, from Buffett, or from someone who was copying Buffett, the same way I learned from my teacher and the way you're learning from me. Benjamin Graham was Buffett's teacher at Columbia. David Dodd was another professor at the school. The compounded annual rate of return for these investors over 8 decades ranged from 18% to 33% per year. The point Buffett was making to the Columbia students was that the people he knows who make over 15% a year for long periods all do it similarly. They all start with rule number 1. After the 2000 to 2003 stock market debacle, when some very good businesses saw their stock values drop by 90%, Professor Malkiel was interviewed, and as we'll see in Chapter 8, he came as close to a retraction of his theory as an academician ever could when he admitted that the market is generally efficient, but go crazy from time to time. Oh. It's efficient, but sometimes it's not. Funny, but I thought that was what Buffett and Graham had been saying for 80 years. Buffett quips that he hopes the business schools will continue to turn out fund managers who believe in EMT so that he'll continue to have lots of misinformed fund managers to buy businesses from when they price them too cheap, and to sell businesses to when they are willing to pay too much. The chart on page 18 shows how rule number 1 investors have fared over the last several decades, as compared with the performance of the S&P 500 and the Dow Jones Industrial Average. How rule number 1 investors have fared in comparison with the market's most popular indexes. This chart may appear erroneous or exaggerated, but it's not. Rule number 1 investors outperform the S&P 500 and the Dow Jones Industrial Average by a long shot, routinely. The magic of compound growth is what explains the massive difference between compounding at 8 or 9% per year versus compounding a little over 23% per year. Such a huge difference isn't so obvious at first glance. Because 23% is just 3 times bigger than 8%, one would automatically think the dollars should just be 3 times bigger. But compounding growth is not linear, it's what is called geometric. Compounding grows a rate of return not only on the original dollar invested, but also on the accumulating dollar returns, interest on interest. Because 23% produces a higher dollar return every year, which, in turn, has a 23% return on it, the accelerating dollar amount explodes after several years and rockets far from the lower 8% compounded return. Cool, huh?
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye-bye.